Well, let's start with the latest on bond markets today. And as US Treasury yields climb to multi-decade highs, global bond markets are also flashing warning signs. Japan's 10-year borrowing cost has risen to a 3-decade high, with its 30-year yield moving above 4%. In Europe, Germany's 10-year yield has reached its highest level since 2011, while French yields are at their highest since 2008. Britain's 30-year borrowing cost has also moved close to levels that were last seen in 1998. The trigger was the pressure in the US bond market, with 30-year Treasury yields touching their highest level since 2007. The pressure is being driven by several factors. The governments are borrowing heavily to finance large fiscal deficits, increasing the supply of bonds that investors must absorb. At the same time, oil prices above $90 a barrel are reviving concerns about inflation, particularly as geopolitical tensions continue. Investors are therefore demanding higher returns to hold long-term government debt. In the U.S. national debt, that is approaching $40 trillion, while the New York Fed estimates the 10-year term premium close to a 12-year high. Competition for capital is also increasing as major technology companies borrow heavily to finance AI infrastructure. Now, the consequences do not stop with governments and investors. Government bond yields set the benchmark for borrowing across the economy. So when yields rise, financing can become more expensive for households as well as businesses. Higher benchmark rates can feed into mortgage rates, student loans, car financing, and business credit. So for governments, higher yields also mean a larger interest bill when existing debt is refinanced. The Conference Board estimates that under its baseline scenario, U.S. national debt could reach 154% of the GDP by 2036. All right, it could reach 154% of the GDP by 2036 and rising to 180% under a higher deficit scenario. That's the case that has been presented. And the key concern is, therefore, a cycle in which higher debt leads to more borrowing. Investors demand higher yields, and those yields make borrowing even more expensive for governments, businesses, as well as consumers.